reference anything or share it with a friend or anything. So okay, I will share my screen. Okay, welcome everybody. Thank you for taking the time to come. And everybody sees my screen with the slides. Okay. If anybody has any questions or anything throughout the presentation, feel free to shout it out, raise your hand, type it into the chat. My screens are taken up by my slide deck, so I might not see it. So if you put in a question and it's been 2 minutes or so and I haven't addressed it, feel free to just scream and interrupt me. Maybe not scream, but talk in a nice, normal voice and interrupt me. Okay, so we're here to discuss how to prepare your business for 2026 so that you can attack it from a point of strategy instead of a point of stress. Because most business owners, I'm sure you're aware from personal experience, they end up flying by the seat of their pants. They're very stressed. They're always constantly fighting fires throughout the day. And that's not really the way that we want to run our business. It's not the effective way to run our business. And it's not the reason why most people open their business, right? They oftentimes, most people start a business because they want freedom. They want freedom to do the things that they want to do and the activities that they enjoy doing. And if you're spending most of your day with stress and fighting fires, so that's not really what you are trying to accomplish in your business. So we're going to talk about a strategic way to avoid that and how to focus on the more important things in your business and how to identify those important things. So the first thing we have to figure out is your business healthy, right? I wanna put a question out there. Who thinks they know what it means for a business to be healthy? You can type it in the chat if you want, or raise your hand. Anybody, or you could just unmute yourself and shout it out if you have an answer. I'll give you my theory.
Positive
I
cash
call
flow.
myself cash flow. Cash flow is definitely a good indicator for healthy business. Hi, Bill. I didn't realize you were here. It's good to see you here now. Um, so as Bill said, cash flow is definitely a good indicator of a healthy business. I want to talk a little bit more broadly for a second. How do you know if your own body is healthy? How do you know if anything is healthy? So the way I like to look at health is that the object that you're looking at is functioning in its intended way. And if your body is not functioning properly, or maybe your dog or your child, maybe their body isn't functioning properly, so something's wrong. You got to take them to the vet, take them to the doctor, get it diagnosed, figure out what's wrong. So in your business, what is the point of your business? What is the function of your business that you can then determine if it's functioning healthily or not? So as Bill said, is it making you money? Do you have any cash flow? Right.
So
And
it has,
yeah.
can I say something? Sorry, it has to be customer orientated. It has to be, well, legal, more or less. Um, Good cash flow. Plans for expansion.
Yeah.
Um, Advertising media should be relatively good. As in,
Yeah.
what else? I can't
I'm,
think.
I'm trying to find the one focal point where you can say this is not functioning the way that I want it to function. And how do you identify that? So what is the main purpose of a business, right? I remember when I was a kid, what am I, oh, not such a young kid. I was in my teens, and my brother was a finance major in college, and he had a book. It was called The Goal, and the whole point of this book, it was talking about a person who is running a widget factory, and and the factory wasn't functioning properly. And he was racking his brain trying to figure out how to fix this. And he went to his mentor, and his mentor said, "Well, what's the goal of any business? The goal of any business is to make money. And if the business is not making money, so then you have an unhealthy business because it's not functioning the way that you want it to function, right? So first of all, the business has to make money, but then furthermore, you as the business owner, you also have to make money. So if you're not making money, so then another indication that maybe you need a little bit of a diagnosis of what's going wrong here. And not only are you making money, but are you making enough money? right? What's enough money? It's enough money to support your lifestyle. It's enough money to pay your bills. Right? Again, why did you open this business? Most people open a business because they have a family to support, or they got bills to pay, they've got rent, they've got a car, they've got a house, they have things that they have to pay off. And if your business is not supporting it, then no, you're not making enough money and there's something wrong. So the way that I like to look at it is that your business has to be looked at like a machine, right? Just like any machine, it has to be diagnosed in the same way that you would look at your washing machine, your coffee machine, right? Any piece of machinery that you have in your house, if it's not doing the thing that it's supposed to be doing, so you have to figure out why not, and you have to get a technician to come in and fix it for you. So we're going to talk a little bit more about the process of how to fix your machine. But first of all, the machine of the money of the machine of the business is something that's making money and it's making time for you, right? You're no longer having to be a slave to your job, right? So you have some freedom there. And if you see at the end of the day that your business is not giving you that freedom, it's not giving you that extra time, so then the machine is broken. So let's figure out, first of all, why is it that most business machines are broken? It might be shocking to learn that 20% of businesses fail within their first year, and half of businesses do not make it past their fifth year, right? 50% of businesses fail within the first 5 years. That means all the time and energy and money that the business owner invested in those companies was wasted. I don't want to say it's wasted, but they have nothing to show for it at this point, right? Within 5 years, they have nothing to show for it. Their dreams and hopes of having a business to support themselves, that's kind of down the drain. And now they have to go figure out how to go back to the workforce and be an employee again. And most of them don't want to be an employee. That's kind of why they start their own business to begin with. So it's kind of a little bit of a letdown. So we have to figure out why it is that most businesses fail, and then how we can fix that. So Don Valentine, who was the grandfather of Silicon Valley venture capital, he said that all businesses fail for one reason. Right? His quote is that all companies that go out of business do so for the same reason. Anybody want to guess what that reason is?
Running out of money.
Exactly. They run out of money. Right? That is exactly what Don Valentine said. And now, again, Don Valentine is somebody who's very successful businessman, very successful investor. So he knows what he's talking about here when he knows what's causing business problems. And all businesses that fail, they fail because they run out of money. Right? Businesses come across problems throughout their existence: marketing, management, payroll problems. All the problems of a business can be solved if the business has more liquidity, has more money in reserve and money available to pay for the different solutions, right? If your marketing's not working, so you can buy you could buy more marketing employees, you can pay for different advertisements, you can hire a new marketing director. If you're having problems with management, so you can hire managers, you can hire a better manager. If there's some sort of down market, right? Maybe you're coming through, maybe you're coming into some situation where your product is just not really desired at this point. So having cash on hand, having reserves is going to help you weather that storm. And if you have a seasonal business, maybe you sell winter coats, you're going to have a lot of trouble selling winter coats in July and August. So how do you make it through the 7-8 months out of the season where you're not making any money? So by having a cash reserve. Right? So his point is valid for pretty much any situation that a business can find itself in. If you have money, it'll help you weather the storm. It'll help you get through that problem, and it'll keep you from failing. So I want to discuss the 3 sources of where money comes from. Does anybody want to venture a guess as to what the 3 sources of money are?
Sure, customers. I'll throw the first one out
Customers, there. Yeah. Customers is definitely one. Again, I apologize. I'm just coming off.
I
of
think
cold.
investors, so you could attract. Sorry.
Investors is definitely investors. Number 2. Yeah.
Your own funds.
Your own funds. So that's, I put that together with investing.
Okay.
The third one. Okay, the third one is actually what I was going to talk about first.
Grants
debt.
or government support.
Debt. You can have debt. by way of credit cards, bank loans. You can have vendors. Vendors is a good one to talk about because a lot of people don't realize that if you, again, let's say you're making widgets and you need to buy plastic in order to produce those widgets. So your plastic vendor, you don't necessarily have to pay right away. You can look at the terms of the contract that you have with your vendor and figure out how can I stretch out this payment so that I have more money in my pocket for longer. So that's a good source of debt that is a perfectly legitimate, again, as long as you're not going against the terms of your contract with them. I'm not suggesting that you should, but as long as you're within your legal rights to not pay them 30 days or whatever it is, those first 29 days, you might need to hold on to that cash to be able to pay your bills. So a good source of debt as well. And of course, there's the classics, getting a loan and getting credit cards. The next one, as we discussed, was investments, owner investments. It could be your personal investments, as I think Eugene said, or it could be selling stocks and taking on new partners, as I think Natalia said, or somebody else threw out there. So these are the two typical ways that people think of in terms of raising money for a business, and they're fine ways to do it. Unfortunately, they're not sustainable ways to do it. Usually, there are two situations where these have to be the primary sources of cash in a business. The first would be that you are in a business that requires a lot of upfront cash. Maybe you're developing a new technology or a new pharmaceutical drug or something where it takes a lot of cash upfront. So fine, you're going to need to take up debt. You're going to need to sell off shares and put in investments at the beginning, and that's perfectly fine. But if throughout the life of the business, this is your main source for cash, it probably means that the business is not working properly and the business can't survive. Unfortunately, most businesses fall into that second category if this is their primary source for cash. So I like to promote making cash from the business itself, right? This is basically just your revenue minus all of your expenses, your income minus your expenses. This is the only sustainable way that you can produce cash on a regular basis for your business that's not going to put you out of business, essentially, right? There's only so much debt that you can take on, especially if you're not able to repay it. And there's only so much stock that you can sell. Once you're at 100%, you can't really sell any more than that. So obviously the clear winner out of the three is from the business itself, as I think Eugene said, from the customers, essentially. So what we need to focus on in order to make sure that our businesses don't fail is to make the business itself a money producing entity, right? We have to look at it as a machine that's meant to produce money for the business and for the business owner. So what does it mean for something to be a machine? Well, like I said, there's many different types of machines in our lives: a coffee machine, copiers, laundry machines, a lawnmower, a car. They all have a purpose, right? Your laundry machine's purpose is to wash your clothes. If it's not washing your clothes, so there's a problem there, right? All machines are made up of several parts. And when there are problems, all of those parts need to be repaired. When you are repairing a machine, right, you call your laundry machine technician in. He's going to figure out which part of the machine is broken, and he's going to figure out how to fix it. And that's his expertise. His expertise is figuring out why this machine is not doing its function, which part is not doing what it's supposed to do, and how to fix it. So you have to look at your business in the same way. Every business machine, every money-making business machine can be broken down into parts. We'll discuss up to 15 parts that I like to break any business into, and as well as a 6-step process that I will teach you on how to diagnose the machine and how to diagnose what's wrong with it, and how to fix it, how to diagnose the solution as well. What happens if you don't? What happens when the machine is broken, right? So you don't have money coming in. Eventually you run out of cash. You can't invest in it anymore. You can't grow the business anymore if you're not investing in it. If you can no longer take on debt. So again, no money to invest in growth of the business, right? One of the things that Natalia said was that we want businesses to grow, right? You want to see that it's improving year after year. Most business owners don't want to stay stagnant, right? Sometimes you do, and that's perfectly legitimate and fine. If you're making $1 million and you're working 2 hours a day and you say this is the lifestyle I want, so great, that's fine. Most business owners want to keep growing; they don't want to stay stagnant. If your business is not, if you don't have the cash from your business to continue investing in it, so you're probably going to struggle to grow. And you're probably going to keep trying to grow and you're going to struggle in that. And you will probably end up going out of business because, again, you need the cash in order to be able to invest. Once you run out of stock to sell, once you run out of debt that you can take on, so you don't have the cash available. You end up stressed out, overworked. Most business owners are underpaid. When you look at a business owner's hours, the amount of time they're putting into it, typically they're getting less than the lowest man on the totem pole. Maybe they're making minimum wage for the amount of time they're putting in. And that's not why we start our businesses. That's not what we're looking for in our business. So we want to figure out why our money-making machine is not making the money that we need in order to hire more, in order to do more marketing, in order to improve our products, our services, in order to invest in better equipment, newer vehicles, better supplies, in order to be able to take time off, spend some time with our family, or to take more money out in order to, maybe add an addition to our house. Right. So why is our machine not working and how do we fix it? That's the objective of this webinar, is to figure out how to diagnose what's wrong, what's causing all the stress, and how to come up with a strategy to fix it. Excuse me. So we want to turn our business from being the job that we own, right? Instead of just owning a job that we show up to 12, 14 hours a day, into a machine that will be able to produce cash almost on its own. So we're gonna learn the 15 parts of the machine. We're gonna learn 4 steps to diagnose what's wrong with the machine, and 2 steps to ensure that the machine is running at peak performance and that it's producing the money that it's supposed to. Okay, so the 5 parts of the machine. Every part can be assigned to one of 3 areas. The 3 areas that I like to look at in a business. First area is revenue. Revenue is basically whatever you sell, whatever money you're bringing in to the business. The next area is going to be your profit. Profit is after you pay off all your bills, you pay your expenses. What's left? What's left of that money that came in? And then finally, the cash flow. Cash flow is probably the area that's least understood amongst business owners, because most business owners, unfortunately, are not finance people. They are plumbers who start a plumbing business. They are lawyers who start a law practice. And cash flow, revenue, profit, these are all accounting terms. And you're not an accountant. Yeah, you people are actually interesting. You're not like me. I'm an accountant. So you guys get to be interesting. You get to be, have jobs that you're proud of. So what is cash flow? Cash flow is whatever you keep at the end of the day. And that difference between profit and cash flow is something that most people don't understand. A lot of accountants don't even understand it. So I want to teach that to you at some point. As we go down the line, we're going to talk about the five parts of revenue, 5 parts of profit, and 5 parts of cash flow. When we get there, I assume there's going to be questions. Again, feel free to ask, feel free to stop me, feel free to put it in the chat, raise your hand, whatever you want. And I imagine there'll be a lot of questions around that cash flow piece. So let's look at an example. I'm a numbers person. I like to see things in numbers as an example. So we'll show that. Assume you make $50,000 of revenue. You sold $50,000 worth of widgets throughout the month, and you had expenses. You had to pay for the people to build the widgets. You had to pay for the plastic. You had to pay for the shipping supplies. All those different expenses. You're left with $20,000. You're going to have other expenses, though, that don't fit into what you might be familiar as the P&L statement or the income statement or the profit and loss statement or profit or earnings statements, whatever it is that your accountant calls it. So that's going to be shown here in this 50,000 of revenue minus 30 of expenses leaves you with 20,000 of profit. Cash flow, unfortunately, takes into account other things that you're not always shown on a regular basis. Maybe you have a tax bill that's coming down the pipe that you're going to have to eventually pay. You're not paying it today. You're going to pay it by the end of the year. But maybe you have a tax bill that's coming down the pipe that you're going to have to eventually pay. You're not paying it today. You're going to have to eventually pay. You're not paying it today. You're going to pay it by the end of the year. but that's going to eat away at your profits. Maybe you have debt payments. Debt repayments are not shown anywhere on your income statement. Those are things that are shown exclusively on your balance sheet. And if you're like most business owners, you're not looking at your balance sheet very often. You're more interested in your income statement. So how do you realize that these debt payments are taking away your cash? You don't. And it ends up being a surprise as to why your cash on hand ends up not matching your profits. Another example is maybe you took you took a draw home, right? You needed to pay for you need to pay for your mortgage, you need to pay for your kids' tuition, your car payments. That's not shown on your income statement. Again, these are things that are showing on your balance sheet. At the end of the day, when you look at your bank balance, you're in the minus, right? You're negative, right? You're actually, what? Do these numbers even add up? No, you know what? I think I have to update these slides. These numbers don't add up. In this example, you still have $8,000. But let's say there's a $13,000 depreciation or something else in your business. So you could end up very easily, if you're not paying attention to all of these other add-ons that aren't shown on your P&L. So you could very easily end up in the negative without realizing it. And you go to your banker and you say, "Where's my money?" And he says, "Sorry, you don't have any money here." "Wait a minute, my accountant says I made 20,000 this month." "Yeah, very nice, but your bank statement doesn't show that." So as you can see, it's very important for a business owner to think about revenue, and most people do. Most people do think primarily about their revenue, but their profit has to be more in the forefront of their brains, right? It's not just a matter of what you sell, it's a matter of what are you earning, right? Your profits is what are you keeping, or what's left after you're paying your expenses. But most important is the cash flow. Even if on paper you're profitable, your business might be making money on your income statement, that doesn't mean that you have the cash available for growing the business. Again, for growing the business, for paying for new and better employees, for paying for advertisements, for paying for your kids' soccer practice, whatever it is. If your cash flow is not something that's at the forefront of your brain, so then you're not looking at what your machine is meant to produce. Right? You're not looking at your machine and seeing, is my machine healthy? If you're just judging based on this 20,000 of profit, that's not telling you, is my business doing what my business is supposed to be doing? Right? Revenue and profit are accounting numbers, and as such, they are theoretical. They are not actual. Cash flow is the only number here that's actual, that's reality. What do you have available in the bank? Any questions on this? Again, this is something that most people struggle with, so feel free to ask away.
Well, I think it's quite predictable. It shouldn't come as a surprise because you know how much tax you need to pay, you know your debts. And
Correct.
what's the owner draws?
But when
Well,
yeah, it should be predictable if you look at the right data at the right time. But unfortunately, most people are just focusing on this number, on these three numbers. They're not focusing on any other payments that are coming out. And that's why they get so surprised when they go to the bank and they're like, "Well, where's my money?" Right?
Oh,
So
I mean,
if you're able to focus on it, then yeah, it is very predictable. Yeah, Eugene, go for it.
yeah. So just out of curiosity, I kind of agree with Talia that these are all predictable numbers because when you look at the revenue and you look at your expenses, well, what are your expenses? If you're manufacturing widgets, plastic, supply materials, whatever. But for example, in my business, I account for costs of not just the products that we sell, but I also account for the rent, utilities,
Yeah.
taxes, so on and so forth. To me, that all comes out of the expense number. And the
So
cash
yeah, so a
flow.
lot of them do. A lot of them
Yeah.
do, and we'll go through those in just a second. On the next slide, we'll definitely talk about some of those. My point though is that most business owners are not looking at all of the right numbers, and they
Okay.
should. And I'm going to
I
give you a
see.
system in the way that you can. And if you
Okay.
have a system that's working for you and you are seeing it, and you go to your bank and you don't have surprises, congratulations, you are in the small minority of business owners. And keep it up. You're doing a great job. That's all I have to say about that. I hope that more business owners can behave in that way. Because the reason why I'm doing this presentation is to give you the tools to look at your numbers in the right way. because most people
Gotcha.
don't have those tools, unfortunately. It's a little painful for me because to me, like a lot of this stuff, it's similar to like what you're saying. It's so simple. It's so obvious. So, it's, there's nothing new here. Right.
Right.
But it pains me how many people out there in the world, this is like completely new and they've never heard any of these things before. And they're, again, most business owners, they fall into being an owner by accident. They started as again, a lawyer in a law firm. They were top of their class. They did great. They eventually open up their own practice because they're so good at what they do. But once you become an owner, you now have to focus on a completely different task. There's running the business is very different than doing the operations of the business. So we're trying to teach business owners how to actually run the business. So the five parts of the machine. We'll go through these one by one. Again, stop me if there's anything here that you're unfamiliar with, and that needs further explanation. So revenue.
If I may ask, Avi, sorry,
Yeah.
shouldn't the accountant be putting those the taxes, the debt under expenses, and then minus that, and then what's left is the profit? Isn't that the more accurate way to do a financial statement?
Wouldn't that be great, right? Wouldn't it be great if accounting ran the way that we wanted it to, right? Unfortunately, accountants have to run according to the rules of accounting. And the rules of accounting, depending on where you are in the world, go by either IFRS, the International Financial Reporting Standards, I think it is, or in the US, there's a thing called US GAAP, the Generally Accepted Accounting Principles. And these things don't always run the way that you would want them to. The main problem here, and we could discuss this later, we could discuss it now. The main problem is that accountants are constantly looking at the past. They're looking to report on what happened. And that's their job, right? Their job is to tell you how much you earned and how much to pay taxes on it, or how much to pay for your payroll taxes, or it's all things that happened on the past. They're reporting what happened. You as the business owner have to be looking forward. You have to look towards the future. Figure out, how do you have a brighter future than what your past was? So they're going to present you with an income statement and a balance sheet that's all telling you what happened. And I like to tell people that that's kind of like looking in your rearview mirror. When you drive a car, you look at your rearview mirror occasionally to gain insights on how to drive forward responsibly. But if you're driving exclusively by looking at your rearview mirror, you're not driving well, right? You're going to be all over the place, and you're not going to get to your destination, not safely, not soundly, not quickly. So your accountant is good for giving you that historical data and that historical information, and you need to use that in order to give you a more predictable future, because you're looking at the data and extrapolating knowledge from it. But if you're living in those accounting statements, just again the way they are presented, because that's the way accounting works, right? We're not going to change the accounting field here in a webinar. You can't live there, right? You can use it, but you can't live there. So the three parts, or the three areas, again, are revenue, profit, cash flow. Revenue is made up of your leads, right? That's potential clients that are aware of your business that you're trying to close as a customer. Conversion rate, how well do you convert them into being a customer? Your retention rate, how many previous customers come back, right? If you're Baskin Robbins, let's say, how many people come in for an ice cream cone every week, or maybe every month, every day, whatever it is. Your purchase frequency, how often do they come back? Do you have customers that are with you month after month after month? Do you have people that it's or maybe you're a one-time purchase? If I don't know, just as an example, if you're a prenup attorney, you don't really want your clients coming back over and over again. You kind of want them to get married. You'll write the prenup right at the beginning. They'll be happily married forever. You don't want return customers there, right? You want referrals from them, but that's really a new client and a new lead at that point. So there's different types of businesses are going to have different purchase frequencies, what they're looking for. If you're a restaurant, you would love if the same client comes back every week. If you only have a person come once, you got problems there. But again, if you're different types of a lawyer or different types of professional services. So it might be a one and done. And then the last piece of the puzzle is your average purchase value, right? What's the average price that you charge to your clients for your services? So that's all the revenue items. Your profit is going to be the things that take away from that cash available, right? The revenue, again, was that $50,000 that you made at the beginning of the month, or that you made overall for the whole month. The profit is the expenses that come out of that. So your cost of sales, I like to look at it as a percentage of revenue. That's going to be the materials and the labor that goes into making the thing that you're selling. So if you are a law firm, that could be your associates, their time, right? Their time is essentially a cost of sale. If you're a widget manufacturer, so the people that are operating the machinery to make the widget, that's also a cost of sale in addition to the material of the widgets. Your payroll expenses is all the other payroll. Could be your secretary, could be your lawyers, could be your accountants, could be the janitor who's cleaning the offices, right? These are all payroll expenses that are not driving revenue by themselves, but they're in a more supportive role to the business. After that is marketing. I also like to look at that as a percentage of revenue for a different reason, more so that I can see, is the marketing actually working, right? Are we actually getting a return on the investment of the marketing? And then last is, or not last, second to last, the overhead. That's going to be your rent. It's going to be your electricity, your copy, your paper, any other incidentals, right, that Eugene mentioned that go into running the business. And then I also like to have a bucket to put other incomes and expenses. That's anything that's incidental, that's not really related to the business itself. Right? I had a client once who he had an office space that he owned, and he didn't need all of the offices, so he rented out some of the offices. So that's rental income, but that's not really what he was doing. That wasn't really, he wasn't in the rental income space. He wasn't renting offices as his primary business. So you need to keep that on the books in order to see what your profit is, but that's not really what we're focusing on when we're trying to drive business to the core service that we're providing. So again, up till here, we have things that most business owners have some grasp on. But now we get to the cash flow. Cash flow is all those other things that eat away at our bank account, aside from the regular expenses, the things that eat away on our bank account and don't show up on our P&L, don't show up on our income statement. It's changes in accounts receivable. Right? An account receivable is basically an IOU that you're giving to your customer for free. You're giving your customer an interest-free loan. Right? They are taking your service, which you then have to pay for. They're purchasing your widget, so your materials are gone, your labor is gone, and they haven't paid you. They haven't paid you yet. So it's very nice to say, well, that's coming up as revenue, that's coming up as income, but you don't have that money. Right? You gave that money away. And until you collect it, it's out there and it's not doing anything for you. Speaking of widgets, inventory of widgets takes away your cash available on hand. Right? You needed to pay for that widget to be produced. You need to pay for the materials, you need to pay for the labor, and it's now sitting on your shelf. So it's cash that you took out of your bank account and put onto your shelf in your warehouse. Right? That eats away at the cash available to pay for the other bills that you have to pay for. Excuse me. If you have to purchase or sell an asset. So that's, again, something that doesn't hit your income statement. It only hits your balance sheet, but it very much can affect the cash on hand in your business. Taking out more debt, paying off old debt. So obviously we said that's a very legitimate way to generate cash for businesses at certain times when it's justified. But again, it doesn't show up on your income statement. So when you look at your P&L, it's not gonna show there if you have a net positive cash. If you're taking on debt or paying off old debt, that's going to affect it. And also investments or withdrawals from the owner. These are the 15 parts that are running your machine, essentially. And when your machine is not broken, these are the 15 parts that you have to look at and see which one isn't working properly. If everybody could just think for themselves or maybe write down in the chat on a piece of paper, which one of these 15, or 2 or 3, whichever, do you feel in your business is in the most trouble and could use the most help? Or Or we can look at it differently. Which is the most important one in your business? Again, you can put it in the chat. You can put it on a piece of paper, write it down. You can think of it yourself, but I want you to try to remember it. Okay. Does anybody have any questions on any of these 15 at this point? Because after this, we're going to get into the process of how to make sure that these are all functioning properly. Okay. So we need to figure out how to transform how to make the business from a job into a machine. That means learning how to diagnose the machine when it's broken and how to figure out how to fix it. And as I said, it's 6 simple steps. First step, we got something in the chat. Overhead expense broken down by customer. Interesting. Overhead expense broken down by customer. I don't usually look at overhead per customer. If it's something that can be broken down by customer, I usually would then put it into the cost of sales bucket. So it'd be interesting to see what it is that you mean by that.
Yeah, I can explain that a little better when the time is right. So,
okay, if you want, we can get on a call later, and you could tell me. We could discuss it one-on-one.
I mean, I don't mind expressing it in the group. I just don't want to cut you up in the middle of the presentation. So.
Okay, yeah, go for it. Take 30 seconds, a minute, whatever.
Okay, so we have services that we offer to a shared customer base, and I know perfectly well what these services cost me at the end of the day, but I struggle sometimes to come up with pricing for customers to reflect accurate number that I can tie to a service that we sell. So as an example, we pay rent in our data center space. It's a fixed number every month. We have a number of customers in that environment. We have maintenance contracts with vendors. Breaking it down into smaller components, which I can build the customer for, I struggle with that. So a lot of it is, let's just put a finger up in the air and just come up with a number.
Yeah. So that putting a finger up in the air and guessing, that's not the right way to do it, obviously.
Yeah. Of course.
So maybe let's talk. Let's talk afterwards and maybe see if we can come up with some ideas on how to address that. Yeah, I mean, dartboard is definitely a good way to go about it, as well as or if experience from other businesses were to be an indication, that's certainly a legitimate way to do it.
Ask my kids. I don't know. I can keep going, but all right. Yeah. Thank you.
Okay, so excuse me. So the first step in the process, right? Setting goals, setting targets. We'll discuss that again further in depth. After you set your targets, you then want to look, again, I'm just going to run through the 6 steps quickly, and then we'll go each one more in depth. So you set your targets, you then analyze, well, how have I been doing towards meeting those targets? You forecast, what do I think the future is going to look like in terms of where I am now? Where do I think I'm going to get to in terms of meeting those targets in the future? I'm then going to create a scorecard or a scoreboard to see, am I meeting the targets or not? Am I doing well or am I not doing well? That's going to lead me to creating an objective. Which part of the business do I want to change and can I change in order to get closer to meeting those targets? And then lastly, what are the actual next steps that I can do? And I'm going to list them in order to change that thing that I just identified in step 5. Okay. So again, we'll go more in depth. Step 1, setting your targets. You want to look at your targets for all 15 of the drivers that apply to your business. Now, again, if you're a lawyer, if you're a law firm, you're not going to have inventory, right? Your cost of goods sold are not going to involve materials. If you're a one-man band, you're not going to have a payroll. So you have to look and see which of these 15 actually relate to your business and set a target for each one of those 15 at the beginning of the year. Right, that's why we're having this presentation in December, is because it's time to start getting ready for 2026, right? And setting your targets, now is the time where you want to do that. You want to figure out, where was I in 2025? Again, looking in that rear view mirror of the accounting statements. and where do I think I can legitimately get in 2026? Right? You want to look at those numbers and project them out for all 15 drivers that apply to you. I have a tool on my website that you can download for free. It's called the Prosperity Playbook. You go on my website. I'll have a link for it at the end of this presentation, and you can just click there, fill out some information, and download. You'll get an email with a download link, and you can put in numbers and kind of play around with them. I'll show you what it looks like in just a second. Once you put your numbers in there and you total up your revenue, your profit, your cash flow, you say, okay, well, what do I think about that target? Is that something that speaks to me? Is that something that's inspiring to me to see that number is what it is at the end of the day? If I meet that target, will I be happy? If I am, great, move on to step 2 and, get on with your year. If not, play around with the numbers, change things here and there and see where can I make changes and what's it going to take to make me happy. So here's what the Prosperity Playbook looks like. Just a couple of columns of it. There's a couple more columns, on the right here where you can actually put in numbers, but it goes through those 5 revenue drivers in the first tab. Your leads and your conversion rate. It's going to tell you how many new customers you can expect. Assuming you meet those targets that you're setting, how many customers will you have? Looking at your past customers, what's your retention rate that you're going to try to shoot for? Put that together, that's going to get you total customers for the year. How many times do you expect each one to come to your business and purchase something that's going to get your transactions? And then you multiply that by the purchase value, the average purchase value, that's going to be your total revenue. Right. The next tab is going to lead to your profit drivers. It's going to start with your revenue. It's going to take away your cost of sales. It's going to get you to your gross profit. Going to take away your expected payroll, your expected marketing, your expected overhead, and any other income or expense items that you have. It'll show you what's your expected net profit going to be for the year. The third tab is going to bring you to the cash flow drivers. It'll start with your net profit on top. What do you think is going to happen with your accounts receivables? How much will they increase? How much will they decrease? Your inventory, you're going to take new assets on, sell old assets, pay down debt. Are you going to take out a withdrawal? Are you going to invest? And that's going to show you what's your expected cash flow for the year. So again, that's step number 1. Set your goals for all 15 of those drivers that impact you. And see, at the end of the day, if I met those targets, I met those goals, the final cash flow at the end of the day, will I be happy with it or not? If yes, great. If not, play around with them. What if I got more leads? What if I got some sales training and I got better at closing those leads? Right? Which things can I change? Which things are in my control?
If I may ask,
yeah.
Okay. I think that part is specifically like turning leads into a conversion, into a success. I think that how much control does one have over that? Because to convince the client,
so much. Where to start? I mean, I'm not a sales trainer. But even I know that if you're running a business, you have to know how to sell. And if you don't know how to sell, if your conversion rate is in the tubes, right? If you're saying, if my business, again, right now we're setting goals, we're not fixing the problems. But if you're just asking in a hypothetical situation, right? If I'm running my business and I'm seeing that I'm getting 1,000 leads and I'm only closing 2, I have a sales problem and I've got to get some sales training. I got to hire a sales coach. And if I don't have the money to hire a sales coach, I got to find the money, because all of those 998 other leads were opportunities that I missed because I didn't spend the couple $1,000s on getting the sales coach. All right. So conversion rate is very much in your control. All of these 15 are potentially in your control. All right. So once we set the targets, so the second step is to track them and analyze what's going on. January, see how January did. February, see how did January and February do. March, right? First quarter, how did the whole first quarter do? And every month, analyze it. See, what am I doing in my business? How many of the leads did I get? Out of the 100 leads that I targeted in step 1, how many did I get? Did I get 10 of them in January? Maybe I got 50 of them in January. I'm halfway there by the end of the first month. Wow, that's great. Maybe I didn't shoot my target high enough. Or maybe I only got 2 leads in January and maybe I overshot as 100 leads. Maybe I'm not even close, right? So see, where am I in all of those 15 drivers that I identified, or maybe I only identified 10 that are applicable to my business, right? So where am I standing at the end of each month in those 10? I'm then going to look and see, where do I think the rest of the year is going? Where do I think the business is going to be in the next 10 months, 9 months, 6 months, whatever it is, wherever I'm holding, however many months I have left in my business. So again, keep in mind seasonality of your business. This is very important for the forecasting. If you are a winter coat manufacturer or winter coat salesman, do not expect that you're going to have any sales in, May, June, July, August, September. Maybe in September you'll pick up again. So don't forecast, well, in January I got 50% of my target of my leads in January. I'm going to blow through that. Let's change my target to being, 50 per month. Well, no, because you're not going to get that many leads in the summer. So keep in mind the seasonality of your business when you're forecasting. The next is look at your scorecard, right? In the Prosperity Playbook, I'll show you an example of a scorecard that we have there as well. That's the 4th tab there. Am I meeting those targets, assuming step 2 and step 3 were added together, and my forecast plays out the way that I think it's going to play out? Am I actually meeting my targets that I set in step 1? Right? And that's going to give me my score. When you keep score in your business, it helps you identify where you're doing well, where you're doing wrong, where the machine is broken. Right? These 4 steps are determining are diagnosing the health of your machine. Is my machine functioning properly? Where is the break? Right? It helps you figure out which of the 15 levers is broken and needs to be fixed. Right? And then in step 5, we'll figure out, well, which one do I want to focus on fixing first? But here's kind of an example of a scorecard. You can have any one of your levers can be either green, yellow, or red. I like to do kind of a 2-pronged attack in identifying them. I look through all 15 of them. If they're meeting their goals, right? You see, like in this example, you got 100 targets and you're forecasting 125. Great, meeting it, it's green. Second scenario, I targeted 100. I'm only gonna forecast 90. Okay, I'm not so far off. I'll put it as yellow. And then I targeted 100 leads. I think I'm only getting at 50 by the end of the year. That's way off. That's going to be red. So I like to go through all of my drivers first and grade them based on that curve, right? Where are they doing against themselves? Green for good, yellow for okay, red for there's an issue here, or maybe there's room for improvement. We'll say there's room for improvement here. Once I've identified which ones are struggling, I can then do step 5. Step 5 is where I'm going to narrow down those red levers or those red drivers to 2, maybe 3, maybe 3 per month. And that's going to be the ones that I'm going to actually focus on for that month. Now, how do I do that? So that's kind of where it's a little bit of a guessing game. And if you don't have a systematic way to analyze different scenarios, it can feel like throwing darts at a board, kind of, or picking things out of a hat. But what you want to do is kind of play a what if scenario. What if I fix this driver and everything else stays the same? So how much of a difference is that going to make? Okay, now I'll put that one back. What if instead of fixing the leads, what if I fix my conversion rate? What effect would that have on the whole picture? Again, you're testing each one individually to see which one can have the biggest impact in the immediate future. And I want to take in step 5, I want to identify just two of the ones that can have the biggest impact if I were to implement change in the next 30 days. If there's some very easy stuff, very low-hanging fruit, maybe I'll stretch it to 3, but I like to try to do it to 2. Once I identify those are the only 2 that stay red, right? Go back to my scorecard. Everything else goes back to being green, or maybe there's 1 or 2 yellows of things that I want to keep on the back burner of my mind. Keep it somewhere that I'm going to not forget about it. But please, for the love of God, you do not want a rainbow colored scoreboard, right? The scoreboard is something that's going to take up space in your head. Right? It's going to show you what's the overall health of your business. And if every month you look at the whole scoreboard and the whole scoreboard is either red or yellow, it's going to cause you stress. Right? It's going to cause you to be very overwhelmed. And that's exactly what we're trying to fight against. So you might look at that at step 4, but step 5, you need to go back. Whatever is not something of imminent value and imminent importance, put it back to green. You want to be left at the end of this exercise by step 5 with maximum 2 reds, maybe 1 or 2 yellows. But everything else, put it green. It's not important for your immediate future. It's not something that you want to be taking space in your brain. Right? You want to take it off of your plate, off the back burner. You'll do the exercise again next month. You won't forget about it. I promise you. Once you have those 2 drivers, again, I want to keep it at 2 ideally. I want to then move to step 6. Step 6 is figuring out what am I going to do about it, right? I've taken apart my laundry machine. I've tested each item. I've tested all the circuits. I know which thing's working, which thing's not working. I put it all back together again, and I'm left with 2 pieces on the end that have to be replaced or have to be fixed before I can reassemble my laundry machine. How am I going to do it? What are the actual next steps that I'm going to do to fix part 1 and part 2, right? Excuse me. And I want to come up with an action plan, essentially. And it's going to tell me exactly the order of steps that I have to do, that once I'm done doing this, the parts will be fixed and we'll be ready to put back into the laundry machine. And my business can thrive again and can be producing the cash that I want it to do. Right. So the objective is diagnosing the problem. Then the action plan is actually doing the fix. So this is just a sample action plan for a fictional company. You know, there may be actually a Mike's construction company out there, but I don't know Mike. I don't know him. But anyway, so a fictional action plan. I like to have a few columns. The first thing is the objective. The objective is, what did I identify in step number 5? I want to list the driver that I'm attacking, and I want to list the direction that I want it to move. Do I want it to increase, to decrease? Do I want it to stay stable? What is it that I'm trying to do to the driver? And where is it holding now? And where do I want it to go to? All right, so that's the objective. The next steps, I'm going to list out what exactly has to happen in order to accomplish that objective. Assuming these next steps are done, taken care of, so the objective will take care of itself. I want to break down those steps into really individual action items. And if there's something that's preventing one of the steps from occurring, I want to list that thing ahead of it, right? So if the idea is to call up different suppliers, if that's the next step I want to do, well, before I do that, I need to have a list of those suppliers that I'm going to call. So if I don't actually have that list already, I'm going to make that list in the next steps ahead of it, right? So that way there's nothing stopping me from going down this list of steps and getting it done. Right. And if there's something that's preventing one of the steps from occurring, then that means it's not the next step. It means that thing that's preventing it is the next step. Once I have that, I can then delegate the steps. Now, this is taking things off of my plate, putting it on my secretary's plate, on my marketing person's plate, on my manager's plate. You know, get things off of your own plate. Why should you be wearing all of the hats in your business? You have employees for that. And I like to give a due date. If you don't give a due date, I think it's a Parkinson's law that a task will stretch out to meet the timeline that it's given. So put a due date, keep it firm so that it actually gets done. And have a place there for notes, just in case there's something that you need to track, to keep note of for future reference. So that's basically it. We got 3 classes of drivers. You want to do the 6 steps on all the drivers every month to see where your business is struggling and what you could do about it. Again, the 15 drivers, 3 categories. I want you to look at what you wrote down as the most important driver in your business, the one that's struggling the most. Now that we've gone through the exercise of identifying the diagnosing the problem with your business, curious to hear if it's the same driver. Was it the same one that you could identify now as saying, this is what's holding my business back? Was it the same one that you thought was holding your business back in the beginning? If you would say now a certain driver is the most important one in your business, is it the same one that you thought was the most important back then? whatever it was 20 minutes ago, 30 minutes ago when we first introduced them. Which of these identify for yourself, which of these drivers do you think you should be creating objectives for in the next 2 or 3 months? Which ones are going to be holding your 2026 back the most? And which ones, if you improve upon, can have the biggest impact on your 2026? Again, things to think about for yourself, for your business. More takeaways. There is a systematic way to grow a business so that it can produce the cash flow that you need it to in order to justify your investment and your time in it. All it needs is a little bit of analysis, a little bit of planning, and then growth is almost inevitable at that point, right? Because you can easily tell what's working, what's not working. And once you're able to do that, you'll make more money, you'll have less stress, you'll make it more efficiently in less time. And as we said, the growth is inevitable when you understand your numbers, you understand how to play with them and how to interpret them to make better decisions with your business. I would encourage you to go to my website, download the Prosperity Playbook, get familiar with it, put in last year's numbers, and set targets for this year. Track your numbers monthly. Don't just look at your P&L, but really look at them from your point of view, from an owner's point of view, seeing what it tells you about going forward in your business and taking your business to the next step, not just looking at what happened and reporting on the past. Think about where things are going in your business and forecasting where you're going to end up at the end of the year on a monthly basis. Again, looking at your Prosperity Playbook on a monthly basis. It's not just a one-time exercise. Use the scoreboard, see where things are holding you back, create your own objectives, create your action plan. I know it's a lot of information. It's a lot of stuff that maybe you haven't been doing in your business up until now, and it might be a little bit intimidating, right? I get that. Perfectly understandable. Most business owners, as we said, are not accountants. They're not number people. Most people don't enjoy numbers. They're not excited about data and information. I happen to thrive on this stuff. I enjoy this type of stuff. That's why I started my business, was because I enjoy working with business owners and helping them identify what's holding them back, so that we can move their business forward and take a load off on their life, kind of lessen some of the stress in their life, so that their business can produce money for them as they intended. And it's something that I enjoy doing. So if you want, here's the link, QR code for the Prosperity Playbook. And if anybody wants to chat about any of this, if you have any questions, you want to look at some real-time data, on a one-to-one, so you can book time on my calendar, and I'd be happy to go through some numbers with you and see, give you my 2 cents on where I think your business is, struggling and where the low-hanging fruit is to improve it. If anybody has any questions, that's pretty much the end of it. And I'll leave this up for a minute, and anybody can feel free to unmute themselves and ask any questions or raise your hands or type it in the chat or anything.
Avi, he delivered a fantastic amount of material in 58 minutes. And I think you sort of answered the question that was rising in my mind.
Yeah.
Most business owners don't have any extra time, right? They're just putting out fires all the time. So does this work best with either an internal or external person that's going to drive the process?
So this system, it depends on the business, right? It depends on the business. If you have a relatively simple business with, maybe it's just you and a VA and that's it, you can do this on your own, and it's going to help you identify those areas that you should be focusing on so that you're not constantly putting out fires, right? The whole point of this is to avoid having to put out fires on a regular basis, but to be able to just focus on your business and what's going to actually grow it. That being said, if your business is more complex, you got 100 employees underneath you. So yeah, you're gonna probably need somebody else to handle this, which you can have, your accountant can help you with it, assuming they have the bandwidth for it. Or you can get an external CFO to help you with it. This is essentially what external CFOs are there to do. again, this is kind of my role. That's what I help business owners do, is run this analysis on a monthly basis and see where are things lagging and where should they make changes. So yeah, again, it depends on the business, depends on the size, depends on how much time the owner has, and it depends on their understanding. This was really kind of an introduction to these concepts. There's much more to be that can be understood here, and this is just kind of giving the beginning understanding, the rudimentary understanding of accounting. It is not meant to be a replacement for a 4-year degree or anything like that. Any other questions?
No
I
questions.
wanted
Wanted to
to
say thank you.
you. It's really interesting, very interesting. I'm not a business owner, but I would like to be one day, and I'm happy that I've attended. Thank you.
Yeah,
Thank
if when that day comes, you're gonna need to know. You're gonna need to know this, because most people, they fall into it, as we said, and they don't understand this beforehand. And once you're in it, once you're in the mix, it's very hard to learn it on the fly. So,
Sure.
yeah.
Thank you.
Pleasure. All right. Have a good day, everyone.
Thank
Thanks
you
for
so
coming.
much.
Thank
Thank
you,
you.
Avi.
Thank you.
Right.
Bye.